What if I told you there's an investment that has returned over 17,000% in the last 10 years? An investment that could have turned $100 into more than $17,000. During that same time, the S&P 500 would have turned your $100 into about 357. Gold, maybe 410. In this video, we're pulling back the curtain on the brutal truth about Bitcoin's mind-blowing returns. Was this a once-in-a-lifetime shot at wealth, or is it a ticking time bomb of volatility you should be running from? Let's get into it. That number, over 17,000%, is not a typo. It represents one of the most explosive decades of growth for any asset in financial history. It's a number that has made millionaires and pulled in Wall Street giants. But it's also a number that hides a dark side. Volatility so savage it can wipe out a fortune just as fast as it can build one. Today, we're looking at both sides of the Bitcoin coin. We'll explore the historic rise that left traditional investments in the dust, and then we'll face the brutal truth of its volatility, the massive price swings that test the sanity of even the most hardcore investors. By the end of this, you'll understand the real forces driving these returns and the genuine risks that come attached. This isn't about hype, it's about reality. For generations, the roadmap to building wealth was pretty simple. Buy a mix of stocks and maybe keep some gold as a safety net. The S&P 500, which tracks the 500 biggest companies in the US, has long been the gold standard for steady, long-term growth. And it's done its job well. Over the last decade, the S&P 500 has given investors a solid 257.6% return. That's a respectable performance that has quietly grown retirement accounts for millions. Gold, the classic store of value, has also held its own, delivering a return of about 310.5% over the same period. In any normal world, these are the kinds of returns you build a future on. They're predictable, regulated, and backed by a whole lot of financial history. But this past decade, a new player crashed the party. It didn't just do better than these old-school assets. It made their returns look like a flatline. This digital upstart challenged the very meaning of growth and made everyone wonder if the old playbook was enough anymore. And then came Bitcoin. When it first showed up, nearly everyone wrote it off as a toy for tech nerds and cryptographers. But the few who threw a little money at it early on saw gains that were nothing short of ridiculous. This isn't a story of slow and steady growth. It's a story of violent, explosive cycles. We all remember the first mainstream mania in 2017 when Bitcoin rocketed toward $20,000, leaving the financial world speechless. After a brutal crash, it came roaring back. In 2021, fueled by big companies getting interested and fears about inflation, Bitcoin smashed its record and hit nearly $69,000. That cycle felt different. It wasn't just small-time investors anymore. Major corporations were starting to put Bitcoin on their balance sheets. Then, after another soul-crushing downturn, Bitcoin did what it always seems to do. It came back with a vengeance. In 2025, it shattered all previous records. On October 6, 2025, Bitcoin hit a staggering peak of over $126,000, driven by a flood of money into new Bitcoin ETFs and massive corporate buying. This isn't an asset that just grows, it expands in bursts. It's the siren song of Bitcoin, the promise of life-changing money that convinces people to ignore the enormous risks. But those risks? They are very, very real. Now for the part of the story the crypto evangelists don't always shout about, the brutal, gut-wrenching volatility. For every rocket ship to the moon, there's a devastating crash back to Earth. This isn't a flaw, it's a fundamental feature of a young, speculative asset. Let's just look at the facts. After the 2017 peak, Bitcoin fell into a nasty bear market, losing over 80% of its value and going nowhere for years. A lot of people who bought at the top sold at the bottom, totally convinced it was all over. Now, look at what's happened recently. After hitting that all-time high of over $126,000 in October 2025, Bitcoin began a catastrophic slide. As of today, February 23, 2026, the price has been slashed almost in half, hovering around the $65,000 mark. That's a 48% drop from the top. Imagine watching nearly half your investment just vanish. The Crypto Fear and Greed Index has plunged to a score of 5, signaling extreme fear in the market as traders panic. This is the brutal truth. The price you pay for those massive returns is holding on for dear life through periods of extreme psychological pain. One of the main strategies people use to survive this is dollar cost averaging, or DCA. It just means you buy a fixed dollar amount on a regular schedule, no matter if the price is soaring or crashing. It smooths out your purchase price and takes the emotion out of trying to time a market that simply can't be timed. For many, it's the only sane way to invest in something this wild. Trying to manage this kind of market isn't easy. It takes a solid strategy, a strong stomach, and the right information. If you want to stay on top of these market shifts and learn the strategies that can help you handle the risk, do yourself a favor and subscribe to the channel and ring that notification bell. While regular investors are battling the waves with strategies like DCA, a much bigger player has entered the game, the institutions, and they are playing with a totally different rulebook. The poster child for this is MicroStrategy, led by its executive chairman, Michael Saylor. Starting in August 2020, MicroStrategy began converting its corporate cash reserves into Bitcoin, calling it a hedge against the dollar losing its value. They didn't just use cash on hand, they got creative, raising billions by issuing debt to fund their Bitcoin buys. And they haven't stopped. As of February 2026, MicroStrategy has kept on buying. In just 1 week, from February 17th to the 22nd, the company snapped up another 592 Bitcoins. This brought their total to a jaw-dropping 717,722 Bitcoins. Here's the kicker. With Bitcoin's price now around $65,000, their entire multi-billion-dollar position is currently at a massive paper loss, since their average purchase price is over $76,000 per coin. Saylor's company is so committed that it keeps buying while the market is terrified. They aren't day trading, they're making a multi-billion-dollar bet that will play out over decades. Their ability to hold through these huge losses separates them from just about everyone else. It's a high-stakes game of conviction that has completely changed the market. For most of its life, the argument for Bitcoin was simple. It's digital gold, a scarce asset with a fixed supply of 21 million coins that would hopefully go up in value. The only way to make money was for the price to rise. But in 2026, that story is starting to change. The new frontier is all about making your Bitcoin productive. Sophisticated investors are no longer happy to just let their assets sit there. They want to put them to work to generate income. This has led to the rise of what people are calling BTC-fi, a new DeFi ecosystem built around Bitcoin. Now, to be clear, Bitcoin itself doesn't offer staking rewards like other cryptos, such as Ethereum. Instead, this new world runs on Bitcoin Layer 2 networks, like Starknet, which allow you to use wrapped versions of Bitcoin. By locking up these wrapped tokens, holders can earn a return for the first time without handing their assets over to a centralized company. This is a game changer. The ability to earn a yield fundamentally alters the math for holding Bitcoin. It offers a potential cushion during bear markets and a way to compound returns during bull markets. We're now seeing a split between passive investors who just hold Bitcoin ETFs and more advanced players who are exploring these new, complex, and potentially rewarding strategies. This evolution, from a static store of value to a productive asset, marks the next chapter in Bitcoin's story. So, after a decade of incredible growth and terrifying crashes, what is the brutal truth about Bitcoin's 17,000% return? The truth is, it's both a historic opportunity and a volatile nightmare. Bitcoin has proven to be a revolutionary technology that has delivered returns unlike anything in the traditional financial world. That performance isn't a fluke, but it is also a ticking time bomb of volatility. The road to those returns was paved with 80% crashes, brutal corrections, and waves of extreme fear that wiped out everyone but the most committed holders. The price of admission is a ticket on a financial and psychological roller coaster, and right now, the market is in the middle of one of those gut-wrenching drops. Today, the game is changing again. With institutions like MicroStrategy making massive long-term bets even when they're underwater, and a new frontier of yield-generating products emerging, Bitcoin is maturing. It's no longer just a question of if you should pay attention, but how. Do you take the slow and steady approach of dollar-cost averaging? Do you follow the iron-willed conviction of the institutions? Or do you explore the new, riskier world of earning yield on your assets? There's no single right answer. But one thing is clear, ignoring Bitcoin is getting harder to do. The real question is, what's your tolerance for the brutal truth? Let me know in the comments below. If you found this breakdown valuable, do me a favor and hit that like button, subscribe to the channel for more no-hype analysis, and don't forget to ring that notification bell so you never miss an update. Thanks for watching.